Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Hi, welcome to Talking Real Money, the daily version. I'm Don McDonald. Thanks for listening, and please call us if you have a question at 855-935-TALK, 855-935-8255. It's really easy, and we answer your calls 24 hours a day, 7 days a week. Well, we take your calls 24 hours a day, 7 days a week. You have to leave a message. We don't have people sitting around to answer your calls all the time. That wouldn't be cost efficient. We don't do that, but we will answer them on the podcast that we do almost every day, except this week, program note, we'll have 3 daily podcasts here, Monday, Tuesday, Wednesday. Today's a Tuesday. Then I'm on a plane Thursday. Then I'm busy all day Friday getting ready for retire meet. So on Thursday and Friday, we'll play last weekend's. We'll put up last weekend's 2 podcasts. So you'll have 5 this week. And you may be missing one on Monday. Depends on how that day goes. And Tuesday, because I'm flying. So we'll see how those go. All right. I hope you will forgive me one more episode on active investing. I was listening last night to a podcast from Vanguard from a couple of weeks ago where it's entitled The Truth About Active Management Myths from Vanguard. Now, most of us think of Vanguard as an index fund house, but they're really not. As a matter of fact, in this podcast, they mention that they have over $1 trillion that is actively managed. And the gentleman being interviewed in this podcast, Chris Tidmore, who is a senior investment strategist at Vanguard, says, quote, "We firmly believe in it." They firmly believe in active management. However, as the podcast goes along, you start to wonder if they really are totally committed and firmly believe in active management, because multiple times he says something like this when talking about how the argument that active managers perform better in a bear market than they do in bull markets. He said, yeah, we looked at that, and we didn't see much overlap. We didn't see much overlap between those fund managers who did well in one bear market and those who did well in a subsequent bear market. In other words, here's what he's saying without saying it. Yeah, those guys did really well in that bear market, but then they didn't do really well in the next one. And the guys who did well in the next bear market didn't do very well in the one after that. And, oh my gosh, wait, could it be that they just got lucky? Yeah, that's what Fama and French have said in their research, in their really in-depth research, that you cannot find managers who do well consistently. And as to the argument, and there's another argument that people make. That argument is that there may be segments of the market that lend themselves to active management because, things like emerging markets or small caps, because there are inefficiencies in those markets. And here's what they said, or he said, Chris Tidmore. We just don't see a persistence in active managers outperforming from one period to the next in those types of things. In other words, we believe in active management because we have a lot of actively managed funds, but that doesn't mean we found any evidence that shows active management actually outperforms after fees and expenses. They even go out of their way to say one of the most important things you should consider in buying a fund are the fees. The lower the cost, the better. That's a direct quote. Yeah, he says you need to find talent, Right. He also then goes on to say, talent is hard to put your hands around. Really? Uh-huh. And then third, be patient. Be patient with an active manager. Well, wait. Why not just be patient with the market then? And pay less. And get probably better performance, or at least as good, and you're paying less for it. These arguments are so spurious, they just don't hold water. There aren't inefficiencies that are exploitable by the masses. And I hate to tell you, love you to pieces, all of you, but we're all the masses. We're not that special, at least when it comes to investing. I'm sure you're very special at something, just not investing. Believe me, you're not. 855-935-TALK's our number. We haven't had calls for a few days, so we'd love to hear from you. If you've got a question about money or investing, give me a call, 855-935-TALK, 855-935-8255. But we do have tons of questions coming in from TalkingRealMoney.com. That's our website, where you can find all kinds of great stuff, take our risk quiz, even set up a meeting with one of our advisors when they stop getting snowed in. Well, actually, they can meet with you on the phone even if they are snowed in. So set up an appointment, talk to one of our advisors, and you're not going to get pressured into buying anything. It's free. It's really easy. They're very nice. They're very good at what they do. And it's, truly, when I say no obligation, there isn't any. 855-935-TALK, that phone number again. And let's see. Let's go to, I'm going to read this question. It's a question from Roger in Pennsylvania. Roger says, hi, Tom Dunn. Tom Dunn. I always read here. I love slashes. I always read /here about, quote, legendary hedge fund managers that always seem to be billionaires, and everybody is listening to their every word. But when I look for actual returns, they always seem to be hard to find. Recent returns I found for some of Bridgewater funds, Dalio, were average, to say the least. I also hear that the average hedge fund performance is usually below the S&P 500, not even the total market, in parentheses. Kramer from CNBC claims, self-reported, to have averaged about 24% a year and only one down quarter in the 15 years he ran his hedge fund. Is there a place to see accurate returns from these funds? Can you shed some light on this in a podcast? For full disclosure, I worked at Vanguard for nearly 20 years, and yes, I am a low-cost index fan 100%. Also, shout out to Jack Bogle, who showed me how to put 4 kids through college debt-free and plan for a healthy retirement. May the legend rest in peace. Could not agree more with that and pretty much everything else you said. I've done a lot of research on Kramer because Kramer is a big league braggart. Is it possible he did 24% per year with only one down quarter? Oh, anything is possible. Is it likely? No. It's self-reported, as you said. He may very well have done well because when he was running that hedge fund, he gave a number of interviews in which he said it was a small fund. He didn't have a lot of money, and it was in the millions of dollars, not billions, and he legally cheated. He manipulated the market a little bit. Now, if you legally manipulate a little bit, might you move the line? Might you cross the line slightly? If the opportunity presented itself and you were pretty sure you wouldn't get caught, I don't know. Hypothetically, you think maybe you might. We know hedge fund managers have cheated. We know it for a fact. Stephen A. Cohen, SAC Capital, his fund pleaded guilty to insider trading and paid ginormous fines. We know they cheat. And yet, when we have funds that do report, not all of them have to, but they report to a hedge fund group, we find that in aggregate, their performance it's not just below the S&P 500, it's dramatically below the S&P 500. Yeah, they make, yes, in a couple of bear markets, they haven't been around for a long time, they haven't sustained the kind of losses that the market has sustained. You would expect that from a hedge fund. The problem with the hedging concept is when you hedge, you are supposed to be protecting people from downturns in the market. And as I keep saying, the market has gone up far more than it has gone down, because remember, everything is past tense. But no, you cannot check these performance claims. And my gosh, I wish there was some way to do that, but it can't be done. Now, back in the day, there was a company, I think it was XO Advisory or something. For many, many years, they did the best they could to track the recommendations of a number of popular stock gurus, like Jim Cramer. And it's fascinating to go look back. Oh, it was CXO Advisory. It's fascinating to go back and look at their results for the time that they did them. I believe that Jim Cramer's recommendations were only right about 46% of the time. That's like flipping a coin, because it was buy or sell, buy or sell. It's flipping a coin. If you flip a coin hundreds or thousands of times, you're going to end up right at 50-50. Some people will end up at 45-55. Cramer ended up looking no better than a bad coin flipper. No better. Well, thanks again for listening. Appreciate you being a part of this podcast. We'd really love to answer your questions at 855-935-TALK. Also, you want to learn more about real investing? Go to talkingrealmoney.com or realinvestingjournal.com. If you want to invest better on your own, you need to understand your risk tolerance. Go take our risk quiz at talkingrealmoney.com. If you have a more detailed question, a more specific question about your portfolio, your investments, we want to help without cost. Would we love for you to be a client of ours? Sure. The more clients, the merrier. We'll hire a new advisor if we need to. And we have. We've been growing like a weed. Did you know that for 2016 and 2017, we were one of the 50 fastest growing firms in America, registered investment advisory firms? And we're now 10 years old, too. Just seems like yesterday. Can't believe it's been that long. But anyway, go check it out at talkingrealmoney.com. Thanks so much for listening. Please call anytime, 855-935-TALK, or visit us at talkingrealmoney.com. Take good care. I'm Don McDonald.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. Are we done now?